Welcome everybody to the webinar today, Eco-Friendly Bitcoin, Investing in Your Future. Host Julian Klymochko. I'm excited to walk you through the presentation today. We'll keep it relatively brief. I do want to leave some time open for some Q&A at the end of the webinar. So if you have any questions, feel free to post them in the chat. So let's get into it. A disclaimer here, read that over. And we will start the materials today. So I wanted to set the stage with this quote. The quote says, "The Times, January 3rd, 2009, Chancellor on brink of second bailout for banks." Now, this is an extremely important quote because this quote was embedded into the Bitcoin Genesis block, and it was representative of the time. If you remember back in January 2009, many of the banks were on the brink of failure, massive liquidity crunch in the market, and risk and volatility really ruled the roost back then. And that was really one of the main causes for the formation of Bitcoin, and Satoshi Nakamoto noted that volatility and that risk in the traditional financial system when setting up the Bitcoin blockchain. So this Bitcoin Genesis block was really how everything started in the whole crypto asset class. So super, super seminal event that everyone should be aware of. Next thing I want to touch on, just a basic primer on digital assets. So many people ask, what is a digital asset? Well, it's just a good that exists in digital form. It's not tangible from a physical perspective, but includes the right to use. Now, you think of digital assets, most popular being cryptocurrencies. However, NFTs, non-fungible tokens, those are becoming popular, or things that aren't on a blockchain, such as intellectual property, royalties, music, digital music, etc., etc. However, crypto assets specifically is a digital asset, so it's a subsector of digital assets, represents a medium of exchange and stored in a database or a ledger known as a blockchain. Now, the most popular crypto asset is Bitcoin, which was the first. It was created about a dozen years ago, but there are thousands and thousands of other crypto assets. I believe there's north of 6,000 these days. Some other popular ones, there's Ether, there's Cardano, there is Ripple, a whole host of additional crypto assets, and a bunch of Bitcoin spin-offs, Bitcoin Cash, etc. But Bitcoin is one we'll be focusing on today because, in my opinion, it's the king of all crypto assets, which now represent an asset class north of $1 trillion and continuously growing each year. So the focus today, folks, is Bitcoin, the king of all crypto assets. It was created in 2009 by the pseudonymous Satoshi Nakamoto, which is a super mysterious thing because no one actually knows who Satoshi Nakamoto was, whether it was one person, whether it was a group of people. And it's a mystery that I don't think will ever be resolved, and is really one of the cool features of Bitcoin is someone or some group created this tremendous asset that allowed for a sovereign digital currency that was really out of the grasp of governments in terms of money printing, inflation, and things of that nature, debasement, such that the people could truly have their own sovereign currency that they could custody themselves and have financial freedom. So to me, Bitcoin really represented financial freedom, similar to digital gold, but much easier to use, much easier to store, and much more difficult for governments to confiscate. So Bitcoin really has no physical presence. It's represented by a balance or a spot on the blockchain ledger. And one of the main reasons it represents a store of value is the fact that it has a limited supply. Now, the Bitcoin algorithm limits the total number of Bitcoins outstanding to 21 million. And that's one of the reasons why store of value. And when you think store of value, that's limited supply. And if you believe that demand will continue to grow, compare that to a limited supply, Econ 101 indicates that the price should go up under those conditions. And certainly many people these days, millions and millions, view Bitcoin as an investable asset class and one that does provide diversification benefits, which I'm going to get into today, more so how Bitcoin is analogous to digital gold given its value and scarcity. So number one, why invest in Bitcoin? Number one, that would be potential returns. Bitcoin is the best performing asset of all time. Basically, if you look at where it was just over a dozen years ago, July 2010 traded at a fraction of a penny, 0.0008. And then by month's end in July 2010, it went up about 100-fold. And ever since, it's near $50,000, which represents a total return of nearly 5 million %. So certainly would have been an attractive trade if you're there in the early days, but in my opinion, still represents an all attractive asset to allocate capital to, but nonetheless has been one of the best performing assets in history. Just looking at some of the returns here, Bitcoin on the left, 1-year return 580%, 8-year return of over 5-year return of over 8,000%, compares favorably to both equities, the S&P 500, and precious metals, gold. So some significant outperformance there, at least on a historical basis, both short-term and long-term. And this is one of the main reasons. Now, this graph on page 8 represents the supply dynamics of Bitcoin. So if you look at the black line, this graph over time represents the expected Bitcoin supply according to the underlying algorithm. So by 2041, the total amount of Bitcoins will be limited to 21 million outstanding. And if you look at the yellow line that's sort of stepping down, that step down function over time, those are the block rewards rewarded to Bitcoin miners for verifying transactions on the blockchain. So each 4 years, we go through a process called halving, in which the block rewards get cut in half. We went through one of those recently, and we'll be going through another one in about 3 years. And typically after a halving, the price has gone up historically pretty significantly. So main takeaway from this slide is limited supply combined with a rising demand. It only does one thing for the expected price and future performance. What's top of mind for many investors these days, certainly myself, are inflation expectations. We just went through the COVID pandemic, at least the worst of it, and it continues to this day. You have the US Treasury and Federal Reserve performing quantitative easing to the tune of $120 billion per month. You have the easiest financial conditions of all time. Central banks continue to prime the pump. And so what are investors concerned about? Well, that's inflation. Inflation expectations, inflation prints are surging. Inflation expectations are at 15-year highs. So that leaves investors scrambling. How can I protect the real rate of return on my assets? How do I protect myself against inflation? Many people view Bitcoin as a way to protect against inflation, just given its limited supply properties, unlike fiat currencies that cannot be printed by governments, and the notion of it being a store of value. As fiat currencies lose their value, Bitcoin should hold up. So inflation expectations are top of mind for many investors, which is then just creating a feedback loop where more and more investors are getting interested in crypto assets, specifically Bitcoin, as a way to protect against the scourge of inflation. The main reason I like Bitcoin as part of diversified asset allocation framework, i.e. in my investment portfolio, is the fact that historically it has had the lowest correlation to traditional asset classes such as stocks and bonds and other asset classes. Now, low correlation means it moves independently of how these other asset classes are trading, and that's really the crux of diversification. For example, if you have a portfolio full of oil stocks and you add another oil stock, that would be highly correlated to your existing assets and therefore provide basically no diversification benefit. However, if you have a diversified portfolio and you add another uncorrelated asset, that is really true diversification. That's what we're looking for in another asset within a portfolio. Can add to that diversification through its low correlation. So that's my favorite thing about Bitcoin, is from a quantitative perspective. Historically, it has demonstrated exceptional diversification benefits because obviously we, or at least most of us, own traditional asset classes such as stocks and bonds. So we ran a historical simulation based on the standard 60-40 portfolio. We looked at the 60-40 portfolio in terms of annualized returns and volatility, and then we made a slight modification to the traditional 60-40 portfolio. So instead of 60% equities, 40% bonds, we did it 59, 32, and 2. So 59% equities, 39% bonds, and 2% Bitcoin. What happened there? Well, you had a pretty significant jump in 5-year annualized returns from 5.5% annualized to 7.6% annualized, so an increase of 220 basis points. You did have a slight increase in volatility. However, the net result is, if we look at the Sharpe ratio, which represents return per unit of risk, over the past 5 years, that represented a 33% improvement in Sharpe ratio, or return per unit of risk, by just adding a 2% position of Bitcoin into a traditional 60-40 portfolio. And we like those metrics. And this displays the historical price performance. The orange line represents the traditional 60-40 stock and bond portfolio. Now the blue line adds just a 2% position in Bitcoin. The reason that we chose 2%, we advise investors when they're allocating to Bitcoin, given it is a highly risky and highly volatile asset, we want people to stay invested and not lose more than they can afford. And we feel like a single-digit allocation, 1% to 2%, is probably appropriate for an asset class of this risk profile and asset class of this volatility, because it has fallen, over 80% a number of times in the past. So investors should be expected to have a long-term framework when investing in Bitcoin and note the tremendous risk and volatility. Now, this is a concept that really has come to the forefront recently, which is the energy intensity of Bitcoin, and related to that, the carbon emissions produced. Now, one of the main benefits of the Bitcoin blockchain is how it is unhackable. The reason that it's unhackable is the energy intensity of the Bitcoin miners validating transactions. They're considerable, right? And that energy intensity is also its key weakness, because when you're putting that much energy into the Bitcoin blockchain, you're producing a lot of carbon emissions. You're consuming a lot of energy to power the high-speed computers, those Bitcoin mining gadgets, the ASICs that are utilized to mine Bitcoin. That consumes a tremendous amount of power. If we look at the graph on the left, the Bitcoin ecosystem consumes more electricity than, say, Sweden, and half as much electricity as the UK. And it's only getting worse. If we look at the graph on the right, forecasts call for a 5-fold increase in carbon emissions from Bitcoin mining over the next 50 years. So energy consumption and carbon footprint is a major concern for many Bitcoin investors these days. And with carbon emissions come environmental effects. So if we look at the graph on the left, this looks at the types of energy production being utilized by Bitcoin miners. Now it's largely non-renewable sources. Estimates are roughly 60% non-renewable power sources, such as fossil fuels, and only about 40% renewable power sources, such as hydroelectricity. So a significant amount of electricity consumption by the Bitcoin blockchain, and therefore a substantial amount of carbon dioxide emissions. And if we look at the graph on the right, that energy consumption has skyrocketed over the past 5 years. So it used to not be an issue, but now it is really top of mind for investors and people involved in the Bitcoin ecosystem is, how can we address the carbon emissions and make Bitcoin more climate positive, eco-friendly. Well, we at Accelerate came up with a unique solution. Today, we launched the Accelerate Carbon Negative Bitcoin ETF that trades under the symbol ABTC on the TSX. Now, this product provides an eco-friendly way to gain exposure to Bitcoin. So number one, we're trading Bitcoin futures, which actually don't go on the blockchain. So they're much more energy efficient than quote unquote physical Bitcoin trades. And in addition to that, we do utilize a portion of our management fee, 10% of our management fee for our decarbonization initiative. Now, this decarbonization initiative is in the form of a global tree planting plan. Right now, we are focused on planting mangrove trees in Madagascar. And I can tell you why. It's a super, super cool idea. And the reason why we're focused on mangroves is that historically, if you look at them from an analytic perspective, an organic perspective, they do sequester an approximate 4 times more carbon dioxide than other types of forests. So focus on planting mangroves in Madagascar. Here's some pictures on the left. And just to give you a sense of the benefit that you can provide when investing in ABTC. So for each $1,000 invested, we estimate that we'll plant about 3.5 trees per year for that investment. And those trees are expected to sequester 1 ton of carbon emissions, which represent over 60-fold the emissions caused by the Bitcoin transactions from the fund. So ultimately, our goal is to plant 21 million trees, one for each and every Bitcoin as part of our decarbonization initiative that accompanies the Accelerate Carbon Negative Bitcoin ETF. Now, it's a novel concept, never been done before. This is not only the first carbon negative Bitcoin product, but the first carbon negative ETF globally. So we're super happy about that. We are excited to be able to counteract the negative environmental effects of Bitcoin and offer investors a way to diversify their portfolio while helping fight climate change. And many people ask, why did you pursue tree planting? There are a couple other ways. You hear of ESG funds. Most of the times they're buying equities based off ESG ratings. But in our opinion, those ratings, if you invest based on ratings, many of the ESG products look frighteningly similar to the S&P 500. So it's really no tangible net benefit for the environment. It's not aesthetically pleasing. And this is often suspected of greenwashing, i.e. mimicking the S&P 500, but looking to earn significantly higher fees by cloaking the product in the green flag. Now, we have seen others pick up some carbon credits, invest in carbon credits, but if you do some research on carbon credits, typically they're issued to, say, a forest owner for not cutting down trees. So in that scenario, they would not provide a net positive benefit for the environment. They would just be preventing a negative for the environment, which is not what we're looking to do. We're actually trying to produce or make the planet a better place. We're trying to more than counteract the carbon emissions caused by our Bitcoin transactions. And carbon credits, trading carbon credits, really just, paper in between middlemen, doesn't, in our opinion, not much for the environment, and also can be suspected of greenwashing. So, which brings us to tree planting. It's definitely a tangible net benefit for environment. These mangrove trees sequester a lot more carbon emissions than any other regular tree. They are aesthetically pleasing. I mean, who doesn't like a new forest where nothing used to be? And can't really accuse anyone of greenwashing if you're out there providing a net benefit for the environment. So we believe that the tree planting initiative is the most eco-friendly and does provide a number of benefits over traditional ESG strategies. So it's a pretty cool combination of ESG and cryptocurrency in a methodology that has never been done before. And so we view forests as nature's natural carbon sequestration mechanism, and the way that we are implementing that through mangrove forests is pretty cool, because they do sequester carbon at a rate of about 2 to 4 times greater than mature tropical forests. So I want to wrap things up for today. Why Bitcoin? Well, number one, it's viewed commonly as digital gold, a store of value, something that can provide capital appreciation within a portfolio, while providing also diversification benefits given its low correlation to traditional asset classes. Remember, Bitcoin has no physical presence. It's just basically a slot in a database or a balance on the blockchain. Limited in supply, so if you believe more and more people will utilize Bitcoin, supply-demand dynamics will give you a good idea of long-term price performance expectations. Now, remember, it does have negative effects on the environment, just given the energy intensity of the Bitcoin blockchain. However, we did launch ABTC, which offers an eco-friendly way to gain exposure to Bitcoin. So we're pretty happy about that. Happy to answer any questions. If you don't have any currently, feel free to reach out. Phone number, my email address. Follow me on Twitter as well. I'll hang around here for a bit in case anyone does have any questions. And if there's no questions, then thank you everyone for joining us on the webinar today. Super excited to share our thoughts on Bitcoin, and looking forward to helping anyone out. If you have any questions, feel free to contact me. Give me a follow on Twitter. And if you don't have any questions, then hope you have a great day.